Welcome to this last chapter, chapter 32, Macroeconomic Theory of the Open Economy. Remember, this is a book of Gregory Mankiw, Principles of Economics. So first, it's important to know now we're going to assemble all the topics that we have seen during the last chapter. So it's really relevant to know that, for example, in the case for the United States, the last 3 decades more import than exports. So it means that for the US situation, net exports have been negative. Is that bad? Is that good? So we're going to go a little bit deeper in order to have own conclusions. So based on the tools that we have already developed in chapter 31, so we're going to build a model. So first, assumption that we are going to do or we're going to have in order to set up this model. First, the GDP is taken as given, because at the end of the day it is determined by supplies of the factor of production and by technology available. So in this case we don't have any incidence from other factors, and we are keeping here the economy's price as given. So prices are not going to change immediately our model in order to develop it, because we're going to center more in an open economy the fluctuations with interaction with abroad, basically. So what is the objective of this model? Basically, we're going to try to determine how the economy's trade balance and exchange rate behave, and then basically we're going to develop with 2 markets simultaneously. So we're going to develop the part of the market of loanable funds and the part of the market for foreign currency exchange. So first, supply and demand for loanable funds and for foreign currency exchange. It's extremely important that we need to be very confident with each model in order to develop the tools, in order to have conclusions. We need to understand really well how each market behaves. So first, this one, the part for the loanable funds. So we have that it coordinates economic saving, investment, and flow or loanable funds abroad, which is the net capital outflow. So the other one that we're going to develop is the market of foreign currency exchange. So as we have seen in chapter 26, all savers go to market to deposit, and all investors go to ask for money. So then, here in an open economy, we start from the identity that saving is exactly equal to the investment plus the net capital outflow. So if we save $1, this dollar can be used in 2 things. First, you can basically, it should be invested in domestic capital or should be used to purchase of an asset abroad. So for example, if you save that in your bank, definitely this money is not going to be frozen there. This should be moved. So for example, in that way, this dollar can be used for domestic capital, so domestic assets, or should be for a purchase of an asset abroad. So then, supply is the saving for this specific market, and demand is provided by investment and the net capital outflow. So it means demand is provided by the money that is basically going, in that case, to buy assets abroad, basically. So we know that the net capital outflow can be positive or negative. So let's recap that. So when the net capital outflow is higher than 0, so net purchases overseas add to the demand. So we are acquiring more assets abroad. In the other case, the opposite, basically the capital resources from abroad reduce demand for domestically generated loanable funds. So it means that other people, foreign people, they are buying here more and more and more assets, more domestic assets. So the price of money in this market is the interest rate, because basically in this case, when you have a higher interest rate, it basically encourages people to save, but it encourages investment. Then, the interest rate in other countries can affect countries' net capital outflow. This is the new thing. This is the important thing is this model, because when there is a higher interest rate in for example United States, people from other countries can invest there, like looking higher returns. So in this case, when you have this higher interest rate in the US, it discourages Americans to buy assets abroad because the interest rate is better locally. So then it encourages as well foreign people to buy it. So then the NCO, the net capital outflow, decreases. So here we have the y-axis, the real interest rate. We have the x1, the quantity of loanable funds. So we have the supply. The supply for this market should be the supply of loanable funds, which is the national savings, and we have as a demand, we have the demand for loanable funds or domestic investment and net capital outflow. So now we're going to find out how we can understand the market for foreign currency exchange. So participants in this market trade US dollars in exchange for foreign currencies. So we start from the base that net capital outflow should be exactly equal to net export. So the imbalance between the purchase and self-capital asset abroad, which means the net capital outflow, should be equal the imbalance between exports and imports of goods and services. Why? Basically, when we have the net exports higher to zero, it means that foreigners, they're buying more US goods and services than Americans are buying foreign goods and services. And then Americans, they are getting foreign currency for this case, right? Because they are getting, instead of selling that, of buying these goods and services, the other people, they are buying more US goods. So Americans, instead of giving these goods and services, they are receiving, they are getting foreign currency. So at the end of the day, they are purchasing foreign assets. So then the net capital, this should be the imbalance for that case. So then supply and demand in market for foreign currency exchange is balanced by the real exchange rate. Then when US appreciates the US dollar, US goods become more expensive relative to foreign goods. Okay, so then, for example, if we are in Mexico and then we have the currency which is 15 Mexican pesos for US dollars, but now you get 20 pesos for $1, which means that the US dollar is getting it's appreciating, then this is more expensive, right? But to the compare with other goods. So exports from the US perspective should decrease and import should increase. So then it reduces the quantity of dollars into the market due to the exports US decrease, and then we have, this should be the situation of this specific market. We have the y-axis, the real exchange rate. We have the x-axis, the quantity of dollars exchanged into foreign currency. So basically we have here the supply, which is complete inelastic. We're going to see why. And then we have the demand for dollars, which it comes for the net exports, right? So then this is the situation for this specific market. So then this should be the equilibrium. And this, it depends on real interest rate, because the supply of from dollars of the net capital outflow should move because of the interest rate around the world. It is kind of tricky, because maybe you can think that when the other currencies, they are more expensive, you won't have any incentive to buy their assets, because by itself the currency is so expensive, so the assets should be expensive as well. But because after you finish your investment, you need to turn these foreign assets into US dollars. So then at the end of the day, it doesn't be, I mean, it is not going to be like really important decision regarding the currency rate. This should be more regarding the interest rate. Then, then for example, a Japanese investor need to convert yen into US dollars. After need to return this US dollar in yen, then the two effects offset each other. The situation of the currency changes. So here we have the situation of the of this equilibrium. So we have a shortage of dollar, and at the end of the day, when there is a shortage of dollar, what happened? Well, when there is a scarcity of any good, the price will increase. That's the case of this. So purchasing power parity as a special case. So then we already saw previously how we can understand the situation of an open economy. Actually, this model said that $1 can buy the same quantity here or any place, because if there is any difference between these two goods, you can make like arbitrage, or you can take like profits with no cost. You can just take the places when it is like really cheap and sent to another place where they are more expensive, and naturally you're going to get the gap. And when this process continues, this gap will reduce to zero and there will be no earns. But actually we know that is not true, because for example there are different kind of goods that you cannot move from one place to another and you can get the same price. Okay, so here we have, well, the situation, if we analyze in the purchasing power parity, should be a demand exactly elastic. Why? Because we are saying that the same dollar can buy any specific good around the world. So for this reason, this is a real specific case that we are not going to explore more. This was just like a first attempt to understand this theory. Okay. Well, the equilibrium in the open economy, net capital outflow. Then we're going to verify the link between the two markets. So we already know that we have the market for loanable funds and we have the markets for the other case, that we have the market for the exchange rate. So then we have a relationship between two markets. Then we have these two situations, which is the S equal I plus net capital outflow. So saving equal investment plus net capital outflow, and the net capital outflow should be equal to net export. So the link between these two markets, to understand the movement, how one change in one market affects the other one, should be the specific one, NCO. So then we know that the market for loanable funds supply comes from national savings. They should be provided by the savers. And demand comes from investment and net capital outflow. So it is balanced by the interest rate. The other market, which is the market for real exchange rate, the supply comes the net capital outflow, and the demand come from net exports. And this is balanced by real exchange rate. So in the market for loanable funds, so we have a net capital outflow, which is a piece of demand. And for example, an American who wants to buy an asset in another country should obtain resources from market of loanable funds. So for this reason, the net capital outflow is like a part of demand for these loanable funds. So in the case for the market for foreign currency exchange, so the net capital outflow is the source of supply. So this is like kind of different here. An American, for example, wants to buy an asset in another country, must supply dollars to exchange them for the currency in that country. When the interest rate is high, it is attractive to have an US assets, so which is when the net capital outflow is flow, because we are not buying foreign assets, we instead preferring domestic ones. So here we have the situation of the net capital outflow, which is zero. Here when we have a special like equilibrium, and this should be the specific one and should be like one part of the link between these two markets. So then we're going to verify the simultaneous equilibrium in these two markets. So we have first the one of the loanable funds, which is provided by demand and supply of the loanable funds, and the link should be the real interest rate, the link with the net capital outflow. So here we have the net capital outflow, which has a negative slope. Why? Because when we have a lower interest rate, we prefer in that case invest in another country. So for this reason should be net capital flow. In the case that we have a real interest rate high, basically the other countries, they have more incentives to invest in our country due to these high returns, and the Americans should follow the same behavior, keeping the investment in the local or in domestic investment. Here we have the other situation, which is the situation of the real exchange rate. As we know, the net capital outflow, the supply, should be provided as specific, like with inelastic, perfect inelastic due to this, which is complete vertical, and then we have the demand for the real exchange with the basically with the real exchange rate. Okay, then, well, imagine the situation of an owner of an apple orchard. So he or she eats some apples. So then we can think, is that an increase in demand or should be a decrease in supply? So both are acceptable. And why we are starting from that part? Basically, because for the market for loanable funds, NCO as a part of the demand for loanable funds could be like this part, because we know that S is equal to NCO plus I. So maybe we can rearrange this one and we can think that's a part of demand. So so exactly should be like pretty much like that. In the market for foreign currency exchange, so net exports are the source of demand for dollars, and then net capital output is the source of supply. Then, for example, if the US resident imports a car made in Japan, so then decrease of dollar of demand, because because now we are acquiring another good. Or a Japanese resident buys a government bond, then decrease of quantity of dollar supplies. So then this is a decrease of the net capital outflow. So now we're going to develop some movement to understand better the movement and conclusion for this model. So then we're going to start with the situation of a government budget deficit. What is a government budget deficit? Well, basically the spending exceed government revenue, which is pretty much normal in a lot of countries. So we have two markets, again, the market for loanable funds and the market for foreign exchange rate. So here is the initial situation that we have like kind of equilibrium, and then we're going to start which curve, which move. So then when there is a government spend exceed government revenue, basically the situation here is like we are touching the supply of the real interest rate and the quantity of loanable funds, basically the market of loanable funds. Why? Because basically when we have that situation, remember that the supply of loanable funds is savings, and savings, it comes from private and from public. And when we affect this deficit from the government, it will affect the domestic saving. So then we're going to have here a decrease of the supply. It will bring a higher interest rate, and then you will have a less quantity of net capital flow, basically because at that situation less people will buy domestic well, in that case should be a net capital flow negative, because more foreign people will invest in American economy due to higher investments, higher returns, and then the supply for this case should be as well should be lower. That should be the situation over here. Basically, another thing here that we have, well, basically, as you know, investing abroad is less attractive because we have a higher returns in our country. This should be a great part. And then American needs less foreign currency. This should be another important situation for this part. We have here an increase or appreciation of the US dollar due to this demand, and then we supply less dollars for this move in the net capital flow. Okay, and then because of that, we have like more people demanding. Uh, then we have an US dollar more expensive. So then in an open economy, government deficit raise real interest rate, the currency appreciate, and this push the trade balance more imports to the deficit. Okay, what about a trade policy? So a trade policy could be a tariff, which is basically a tax on imported goods. Should be a quota. Then you have a limit for the goods that you are importing, and then you know that this should affect net exports, which is the demand. So then the net exports increase for decrease of the imports. We can think that at the beginning, but then we will have an appreciation of the exchange rate, which makes more imports, so make no change in net exports, so it offsets the previous movement. So then let's start from the equilibrium. So we have this situation. So first, trade policy will bring this movement in basically here, because then we will have that part that basically, well, as you see here, we have a higher real exchange rate, but it's really important that we don't see any change in net exports, because from one side you have a decrease in import, but from the other side you have an increase in the exchange rate. So remember, when there is an increase of the exchange rate for the US dollars, they are more valuable. So then for other countries, they prefer to export to United States. So it means import for the US, because this should be more revenue for them. So then, this is important fact that we have, that the trade policy does not affect trade balance, because actually this does not affect saving or investment. And then maybe, as should be normal, that it could affect some specific industries, firms, or even some countries outside, but in general should be no changes in trade policy. For example, if we are making an import for automaker, something like that, so we are going to have from Japanese that we stop the limit, we limit the quantity that they can put into the American economy. Then basically General Motors, they will have less competition. But for example, other industries are Boeing, due to the appreciation, it is more difficult to compete outside, because this dollar costs more. So trade intervention will reduce overall welfare at the end of the day, because as we saw in the first chapters, any intervention for the government will create deadweight loss, and then should create less welfare for all people in the economy. So other should be the political instability and capital flight. And famous example should be the situation of Mexico in 1994, when there was like impressive capital flight due to instability of political situation. And basically what happens, a lot of money goes out from Mexico. We are going to analyze that from the Mexico's perspective, so that we will have here an increase of the NCO in Mexico because of the capital flight. So then the NCO affects the loanable funds market, and we have here a higher demand for capital assets abroad instead of Mexican assets. And then we have here supply of pesos increase, because more people, they are offering their pesos to buy another capital assets abroad. So then for Mexico, the exports they are cheaper and the imports are more expensive. So Mexico should have more earnings from exports and less imports due to the price. So here we have again, we start from the equilibrium of these two representations, and then the change should be what? If you want, stop the video and think a little bit what should be the change, which curve you will affect. Okay, right. Here should be the one of the demand in the loanable funds, basically because in this case we have more people in the net capital outflow, more people buying foreign assets. So this will be a change in this specific demand for loanable funds. We have an increase of the interest rate. So if any interest rate should be an increase in the net capital outflow, so then should be a net capital outflow to the right due to the capital flight. And as a consequence, we have here a E2 E1 from E1 to E2 due to the decrease of the interest rate, because it is now depreciated. Okay, as a conclusion, now we have definitely more interdependent economy. As you can see with this COVID-19, one thing happening in one country, it affects all of Earth. So definitely something to be to keep an eye a lot. But actually, we know that the thing is, like, there are a lot of myths around the open economy and now around the international trade, and actually sometimes it says that the issues in the economy or the problems in the economy is because of the international trade. So for this reason there should be more protectionism, but at the end of the day, as we saw in the previous chapter, more protectionism would generate at the end of the day just like part for the government, and then should be less situation of specialization of countries due to high cost of exports, and at the end of the day everybody will hurt for that decision. Okay, well, basically that's the part. I hope you can understand better that situation. As I said all the time, this is subtle. This is just my comments, how I interpret this chapter. I hope that you can follow easily the lesson. And please subscribe if you like it. And keep safe, keep healthy. Bye bye.